Hey everyone, this is FinPony. What if you picked one stock and just T'd the hell out of it all year? Sounds insane? Nah. For retail traders, it might be the secret sauce to stacking serious gains. Most people bag hold and blow up their accounts because they can't TTing is the quickest way to cut your average cost, and it's one of the only real edges retail traders have full control over. Simple introduction to doing T. Prerequisite for doing T is hold a stable core position that you never sell. Then repeatedly buy low and sell high, or sell high and buy back low intraday, using price fluctuations to earn the difference. Over time, this gradually lowers your average cost, and if done consistently, you can even grind it down to zero or negative. Doing T mainly falls into two types. One is positive T. Buy low first, then sell high later. This is suitable when the trend is upward. Another type is reverse T. Sell high first, then buy low later. This is suitable when the trend is downward. Whether it's positive T or reverse T, the core logic is the same. Use intraday price fluctuations to repeatedly earn the difference, gradually lower your average holding cost, and with consistent execution, you can even push your cost down to an extreme low, or even negative. Today, let's talk about intraday T+0 trading, repeatedly buying low and selling high, or selling high and buying low within the same day. Take Tesla as an example in the US stock market. Open the intraday chart and focus on two key lines. The yellow line is volume-weighted average price, which acts as the intraday average price line. The blue line is the real-time price line. Once you understand the deviation between these two lines, you'll master the rhythm of doing T. We can remember the key points of US stock intraday T+0 trading with these four color rules. First rule, when the blue line is more than 5% above the yellow line, hold off and don't chase. When the blue real-time price line quickly surges more than 5% above the yellow VWAP line, be extra cautious. It might keep pushing higher, but it's also very likely to pull back. If the deviation exceeds 7%, don't do T at all. Better to miss the move than get shaken out. Second rule, when the blue and yellow lines are within 3% of each other, don't move. When the blue real-time price line and the yellow VWAP line are oscillating within just 3% of each other, the profit margin is too thin. Transaction fees can easily eat up all your gains, and you're prone to buying high and selling low. So during sideways chop, be patient and wait. Don't mess around. Third rule, when the red line falls back to the yellow line, that's your buy point. After selling high or buying low, don't rush to reverse the trade. Always wait for the blue real-time price line to pull back and approach the yellow VWAP line before taking your next step. This is the key rhythm to avoid getting whipsawed. Stick to it strictly, your average cost will keep dropping, and your profits will snowball bigger and bigger. Fourth rule, when the red line pulls away more than 3% from the yellow line, take action and catch the pullback. When the blue real-time price line pulls more than 3% away from the yellow VWAP line, either upward or downward, that's your golden signal. Because when the price deviates too far, it will definitely return to the yellow VWAP line. If it surges too much, upward deviation 3%, sell at the high point, then wait for the price to pull back close to the yellow line before buying back in. If it drops too much, downward deviation 3%, buy at the low point, then wait for the price to rebound near the yellow line before selling out. The difference between your sell and buy prices is your profit. The core one-sentence rule for intraday T trading. Watch the red-yellow color difference, catch the pullback, and stick to discipline. Once you fully understand the distance relationship between the yellow VWAP line and the blue real-time price line, you'll clearly know exactly when to take action and when to wait. That's all for this video. See you in the next one.